Hello everybody, let's talk about average rates of return versus actual rates of return. As you know, when you're looking at your business and you're looking at investing money, you want your capital to be as efficient as possible, right? Well, one of the misconceptions in the investment world or in the market is this notion of average rates of return, because that's what you see all over the place. That's what you're going to see in investor documents. That's what you're going to see whenever you're looking at mutual fund investments or the stock market and things like that. But there's a big misconception in what that actually brings you back. So when you look at this question here, are your average rates of return your actual rates of return? The answer to that is an emphatic no. So the next question is, well, what's misleading? Or how misleading can average rates of return be? They can be pretty significant. And so let's look at this hypothetical example that I have. When you look at this, I'm going to take 4 periods of time. And the first period, the market's going to go up 100%. Then it's going to go drop 50, then it's going to go back up 100, and then it's going to drop 50 again. If you average that performance out, that's going to give you a 25% average rate of return. But when you put actual dollars to that scenario, it's much different. So let's say in period 0, so starting off, we're going to just invest $100. If you invest $100 and the market moves at that same rate, it's going to go up to 200, back down to 100, up to 200, back down to 100. When you look at what you actually made over that those 4 periods, your actual return was $0. So the question is that good? Well, obviously not, right? And you can make the argument, well, Nick, that's a hypothetical scenario. That doesn't happen in real life. Well, let's look at the S&P 500. We're going to look at the last 20 years, starting out in 1997, going up to September of 2018, right? So almost 21 years. So in the first period of time, from about 97 to 2000, it went up 67%. From 2000 to 2002, it dropped 49%. From 2002 to mid to late 2007, it went up 101%. Then it dropped 57% in the next pullback. And then from then to September of 2018, it's been up 333%. So if we look at a calculator and do these calculations, our average rate of return in that almost 21 year period of time would be 79%, or just under 4%, so about 3.95% per year. That's what you're going to make on the average scale. But look at the actual numbers. The actual return was 26%. Which means you made about 1.3%. You actually made about 1.3% per year. So when you look at fees and inflation and things like that, you have to ask yourself, is this the most efficient place for your capital? Is there potential in the market? Absolutely. Is there risk in the market? Absolutely. The main thing is you're trying to be as efficient with your capital as possible to get the highest rate of return for yourself and your business. So make sure when you get into investments, you understand the difference between the average return versus the actual return. And we'll talk to you next time. Thanks for watching.